Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently I have been getting messages from brothers and sisters who own this company or would like to own this company, and they just want to know my opinion or what I think about the company. So I'm just going to give you an overview of the company first. Then we're going to talk about the financial details. So what the company does, financial details, valuations. Then we'll compare this with the S&P 500 and see how it has performed against the S&P 500 over the last 10 years. Then I will tell you my plan of what I would do with this stock moving forward. And because I've got this so many messages from brothers and sisters, this is the reason why I decided to share with you guys today. And the company we're talking about today is West Management. But before I get to this, okay, can you please join us in the Patreon account? If you can, send me your portfolios. I'll give you a review, inshallah. Even if you don't want to do that, then there's a lot that you can get out of by joining us in the Patreon account. Things like, you know, the family portfolios. You can ask me any questions. You can also get access to the the individual stocks that are normally analyzed. I've been sharing spreadsheets of high dividend yielding companies that are Sharia compliant, all dividend growth companies that are basically about 15 of them last couple of days. So yeah, just join us. You get a lot out of it, inshallah, and it definitely helps the channel and supports the channel. So the company we're looking at today is West Management. This company, it's simple, okay? They collect garbage, they recycle it, they do what they need to do, and that is what they have been doing for a very, very long time. So with regards to residents or commercial or industrials, they work with everybody and they collect the garbage and they recycle it by all the waste that they've collected and so on. So that is really genuinely as simple as it gets, okay? And for what we now need to do is financially see what this company where is that right now. And as you can see, is it has a market cap of 91.5 billion, which is a large cap. 1.4 and when it comes to the dividend yield, and is that dividend is safe right now, 80% safety. 99 is the highest any company can get. And as you can see, credit ratings right now is A-, which is strong right now. Now a couple of other things with regards to that dividend. 43%, that means they can increase this dividend anytime they want. And the latest increase, which was December 2024, was 10%, which is nice, and about almost 8% in the last 5 years. This is one of the reasons I really would like to own this company. And I did own it at some point, and it was too expensive. I couldn't add to it, so I left it alone. 21 years of increase in that dividend. They will definitely get to 25, and that will make them a dividend aristocrat. So they have been growing this dividend for 21 years in a row, and as you can see, that last 5 years the average has been all basically about 8%, which is really good. You get $3.30 for every share of this company that you own. Now looking at a few other things, so the payout ratio we've seen is basically slightly lower and is getting lower, which is nice to see. The earnings per share, look at this, from $2.61 to right now $7.76. Okay, so it has been growing every single year for the last, apart from 2020, that's the minor drop. It has been going up every single year for the last 10 years. Now the other thing we need to look at is shares outstanding, and as you can see, it has been declining every single year, but they're this is very interesting. They are diluting the shares this year for the first time. It will be interesting to find out why that is the case. But yeah, slight dilution in terms of shares, but sales from $13 billion to almost to $23 billion in that 10-year period, which is quite nice to see. Return on equity, we're looking about 34%. Return on investor capital, 10%. Operating margins of 19% and free cash flow margin of 8%, which is nice to see. Net debt to EBITDA, for example, is basically normally what we're looking for is 3, is below that 3, which is quite nice to see. And net debt to capital is basically 0.73. Normally what we're looking for 0.4, so it's slightly higher than basically what we're normally looking for. Now that's just the financial side of things, so I'm going to show you a couple of things about the company. And the first one is the financials. If you go to what we want to see, we know that revenue. In fact, let's go back to income. Okay, we look at the revenue here. You know it's growing every single year. So they made about $23 billion, but look at the cost of that revenue, about $14 billion. So they're almost the take home is about $9 billion. Again, they have to pay taxes. They have to use some of that money of research and development and other things. So what we now need to see is the net income, $2.6 billion basically this year, which is quite good. So a slight decline from the previous year, but it's 2.6, which is quite good to see. And as you can see, the basic EPS has also been growing over the last whatever years. Now the next one is the financial and the balance sheet that I want to see against. I want to see the total assets against total liabilities. $44.4 billion of assets right now as we speak for this company, and total liabilities of $35 billion. So basically they have more assets than liabilities. So then you don't have to worry about the company getting into liquidation or anything like that. So now we have the understanding on the financials. So we know that basically the revenue is growing, we know EPS is growing, the company has been buying back their own shares, we've seen the profitability side of things. Okay, so these these things here, the what is it called, return on equity, return on invested capital, and so on. We've seen all of that is basically well so far. Okay, now what we now need to look at is the valuation side of it, and I'm going to start with the ratings from Wall Street. Wall Street is saying is a buy right now. We've got 10 strong buys, 4 buys, 10 holds, and then we've got 1 sell. And that's about basically about 11% upside from where we are. 200, let's call it 250 is where they think the price should be. Right now it's $225 per share. We will look at the earnings expectation also moving forward, because valuation is important, but without the earnings we wouldn't know where we are heading. So this year they're expecting about 5% growth, next year about 14%, next year after 14%, and then 2%. So it's a little bit cyclical business, if you like. 15% when it comes to revenue, the next year 5%, then 5%, then 6%, and so on, which is very interesting, right? Now what we need to look at is using Morningstar valuation. Okay, so this is the company. So as you can see, $195 per share is where they think the price should be. We've already seen the price is basically over $225 per share, so it's slightly higher where it should be. That's why it's basically 2 stars, and the company has a wide moat. Now I'll pause the video here, you can have a look at what the bulls and the bears are saying about the company. I'm not going to go into that basically details. You can pause the video, have a look at that. And also the other thing that you would be interested in basically is to look in the business side of things, basically what Morningstar thinks and the reasons why they've given the valuation that they have given. But now I'm going to move on to fast graph. Okay, so as you can see here, I'm on the summary section, and as you can see here for the last, in fact I'm going to go to historic side of things, and there was a times where this company was trading basically undervalued. Okay, and that was 2009. Since then, here and there it just dipped below that, that orange line, which is the fair value side line of things, right? And basically which is the earning side of things. And since then it has been growing every single year. Okay, which is really interesting. For a company like this to be overvalued so much is absolutely crazy. And I have seen that because I did own it in 2020. Then I had to sell it because it was only 5 shares, and at the time it was trading very expensively and I couldn't add to it. So it really made no sense just to hold on to just 5 shares. I sold it. Again, I did the same thing in 2020, 2024 again, and beginning of 2025 I think I sold. So it has been trading, basically it has been very expensive over the last whatever years. Now the other thing I want to show you now is the moving forward, what is the expectation for this company. And we've seen already the earnings expectation of about 5% this year, next year about 13-14%, next year about the year after about 11%. So the next 3 years, this is basically the expectation, and based on that estimates, based on the estimates that we have, if you bought the stock right now, your 10,000 investment will become 6,700. So you will be losing about 32% of your money, which is not good at all. But if you use the normal multiple, which is what Mr. Market likes to trade this company, which is about that 28 PE. Let's go back to the normal estimate because this is important. That's about 15 PE. But we're now looking about normal multiples of basically 28.5. That means if that was the case and we hit that target, basically we will be making about 2,500 on top of the what you made already, what you invested, which is basically $12,525 per share, or 25%, or total and basically annualized rate of return of about 10%, which is quite nice to see. Now, how does actually this company perform against the S&P 500? So the performance side is what we're looking at now. So if you invested 10,000 USD over the last 10 years and you left it alone against the S&P 500, so that we're comparing it with basic SPY, and we've got now the 10,000 investment at the end of the compound growth will be about 11% for this company, and the S&P 500 9%. So you would have actually, companies that basically deals with garbage is actually outperforming the S&P 500, which is nice. The average dividend growth rate for the last 20 years is over basically 7%, and the same things for the compound dividend growth rate as well. So in comparison to that 7%, it is 6%, 6% in the S&P 500. So it's really high, more or less a high growth company, and it's expected to grow decently in the next couple of years. So it is really in a good position, but I still genuinely think it's still overvalued. I would love to buy this company around the price about less than $200 per share. If you can find this company less than $200 per share, I think that will be a good point, basically entry point. But it hasn't hit that price for quite some time, so I can't imagine it. I think the last time it was below, let's see, what is that, 200 there, basically was January actually. So when maybe this will be interesting. See again, yeah. So this time, basically last year, it was below $200 per share, but since then it actually hasn't hit that. So overall, all I'm saying is a great company, basically great company, and you potentially will, is one of those companies you can buy and hold for a very long time. But right now it seems a bit expensive, so I would say below 200 will probably be a good entry. If you can find even below 180, 190ish, that would be absolutely amazing. But let me just show you Refinitiv what they're saying. $250 per share is where they think the price should be. Tip rank, for example, let's see what they're saying as well. $225 per share, about 13% upside from where we are, and it's some strong, basically a moderate buy from this. But they sample these guys, so again, these are based on Wall Street analysts. So you can see all the big boys here. Basically, they have a 5-star ratings, are all saying whatever they're saying about this company. So right now for me is a pass, but if you are interested, just wait basically until it hits maybe 190, below 180ish, and then if you can load after that, you can load up. But right now, just leave it alone in my opinion. But if you're buying it, just nibble it here and there whenever you see a drop, maybe after the earnings, because the earnings season has started, then maybe you could add to it, inshallah. Anyway, if you haven't joined us in the Patreon account, please do so. It really genuinely helps the channel, and of course you get a lot out of it. Try it out, inshallah, and let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.